Hi everyone. In this video, this is the first of the chapter 12 homework walkthroughs, and we're gonna start with homework problem 12.1 here on the first tab. And so in this problem, we are going to prepare the cash flow statement for the Monica company using the indirect method and the following information here. So we've got that kind of broken down. We have our cash from operations section. We have net income, and I've listed out just the changes here. And so I kind of let those in just because I think that this is a more challenging conceptual chapter, and I want you all to start thinking about these things, but I want you to also have kind of a guide in your thinking so you're not totally getting lost. Okay. So when we're doing our statement of cash flows, we always want to start with net income and the operations section, and then we're going to adjust for changes in non-cash assets and then liabilities, etc., and other non-cash expenses and revenues if we have those. And so let's start with net income. So we'll just link in to $600. Excuse me. And then let's also then look at our changes to the assets here. And so AR decrease, and let's kind of think this through, right? So remember that when we have an AR increase, that's revenue earned without cash being received. But when we have AR going down, that is reflective of cash. The receivable goes down because we've actually been paid the cash essentially in that instance. So when AR goes down, that's going to be an increase to our cash impact, our cash flow from operations. So we'll have that one as positive. Then let's look at accounts payable. So that's a liability, kind of on the other side of the fence there. And think about accounts payable then. When accounts payable, I think it's a little more logical to think when accounts payable decreases, that's us paying down our liabilities, right? So that would be, for my brain at least, that's a more logical connection to say, oh yeah, accounts payable is going down. That means we paid down accounts payable with cash. In this instance, accounts payable is increasing. And so we're going to take kind of the opposite approach. So cash will be going up then. And so we can say, okay, if AP increased, that's going to be more of an increase to our cash flow from operations. And, to think through that one logically, essentially what's happening is if AP is increasing, it means that within net income, there are expenses that are not representative of cash actually being paid, but instead accounts payable liability being increased. So, but for my brain, I think sometimes if you can, it's an either or. So if you can think of AP going down being a cash outflow, then there's only one other option. If you have AP going up, it's going to be an increase to cash flows. So if whatever works best for you, but just that's kind of how my brain sort of works when I use logic on these. So, okay, as far as depreciation expense, remember that's a component of net income. So, it brought down all the, it was somewhere up above, and we ended up with net income of 600. But it's a non-cash expense. And so we need to, add that back to get just the pure cash flow impact from operations. So we're going to make that positive. Prepaid expenses decreased. So again, this is one where I kind of think the opposite helps me think through this logically the best. So remember, when prepaid expenses increase, that's a cash outflow because we pay cash for our prepaid expenses that we'll utilize in the future. So that would be a negative impact. But with prepaid expenses decreasing, then it's basically the opposite. So a positive impact. And again, the way to think of that is really like if we're incurring rent expense because our prepaid rent is going down, that is included as an expense leading to net income, but it's not a cash. The cash isn't going out leading to that rent expense. It's our prepaid expense going down that's causing the rent expense. But again, I think more logically for my brain, it's quicker for it to think, okay, prepaid expenses is going up. That's a cash outflow. That's the journal entry, cash credit, debit, prepaid expenses. So it's the opposite of that, and it would be an increase overall. Okay, tax payable increase, very similar to like what we said about the AP increase. And one thing I'll just point out is if you see payables with an increase, you can also then deduce that any other payables that have an increase are going to have the same impact. So if AP increase is positive, then a tax payable increase is also going to be positive because they're both liabilities. So once you kind of have an anchor in a few things, you can just sort of follow that same logic. So tax payable, where's my, here we go, 300. Okay, loss on sale of equipment. So that was, again, a non-cash reduction leading to net income. So we need to add that back. But this one we have to actually calculate here. So it tells us a few things here. It tells us that the proceeds, so the cash received from the sale of equipment was $350. It tells us that the book value of the equipment when it was sold was $400. And I'm going to put that in as negative. So negative $400. And so then we take the difference, and basically we can see it's a loss. And to walk you through the logic there, the book value is, historical cost minus accumulated appreciation up until the point in which the asset was sold. And if we receive less cash than the asset's value at that time, it's a loss. If we receive more cash than the book value at that time, it's a gain. And so that's why we do the cash minus what the book value was. So we received less cash than the book value, so it comes out to be a loss. And again, it was a loss, which reduced our revenues to get to net income. So we have to add that back because it's a non-cash subtractive item, kind of like expenses essentially. Same like I'm just mentioning here. So we need to add back amortization expense because that's a non-cash expense. And then finally, we see wage payable decrease. And again, anytime a payable decreases, that's because we have paid it down with cash. And so that's going to be a reduction. And then you could sort of use logic. Oh, if AP increase was positive, then a payable decrease is going to be negative. That's another way to think through it. Okay, so then we get all those together and do a summation formula to add up all the amounts here. So our net cash from operations was $1,250. And then the proceeds from the sale of our equipment here related to that sale, we can just take it from here or from here. And then we purchased a building. That tells us it was $920. And that's going to be negative, right? Because we're purchasing something. So you can kind of think through the logic there. Just negative makes sense, right? We're buying something. We sold something here, so proceeds, cash coming in. Bonds payable decreased, and again, a payable decrease means we're paying it down with cash, and so that's going to be a negative as well. If I can find it. Dividends paid is cash outflows from our equity, and that's going to be a negative as well. Whenever something's paid, it's a cash outflow. Stock issuances raises cash, so that's going to be positive. Hit our auto sum. So $80 net in positive cash flow from financing. And do remember, keep in mind, investing has all of our investments or long-term assets. Financing section has all of our borrowing or repaying money, anything equity related, and then everything other than that, operations-wise, falls up into the first category. Okay, so now we've got all three categories kind of complete there. So let's just add up the totals from all three. So we have a net cash flow increase of $760. And then we can put in our beginning cash flow. I think it tells us that here. So beginning cash balance. And then our ending cash balance is just adding the cash flow to the beginning to get a total. And then it gives us a kind of a check figure here of $860. So we can just link to that. And then I included this little check figure spot. So I like having check figures. It's a really handy way to make sure you're your numbers are balancing. It's kind of easy to see in this instance anyway, but I would recommend just getting in the habit of having some sort of check figure. So here we can do a formula to say, here's what the instructions told us minus what we actually calculated. And since they're the same, it has a note here, it should be 0. If you did your work right and you balance out, just kind of like, even, you think of something like debits have to equal credits. That's not exactly what's happening here. This isn't debits and credits, but it's a similar concept where if this doesn't match to your in figure, you did something wrong above, essentially. So the fact that that goes to 0 is a good check figure to show that we've done all of our work correctly. And yeah, that's pretty much the whole process of the problem. So hopefully some of those little hints and tips, I know this part can be a little tricky in terms of thinking through logically what is happening with the assets and liabilities and things of that nature. So hopefully that's helpful, and we will work through a few more problems in the coming couple next videos. So thanks everybody, and I will see you in the next video.